Well, greetings, my beloved clients and friends. I've recently done a couple of videos on some key topics from Benjamin Graham's book, The Intelligent Investor. Those two key topics were margin of safety and Mr. Market. Okay, and I want to do a third one, and this is on a topic that is not widely recognized and not universally touted. It's kind of a sleeper, and it's from chapter 16 in Graham's book, and the chapter is entitled Convertible Issues and Warrants. And let me just read one section real quick, and then we'll unpack that. Here's what he says. Convertible issues are claimed to be especially advantageous both to the investor and the issuing corporation. The investor receives the superior protection of a bond or preferred stock, plus the opportunity to participate in any substantial rise in the value of the common stock. The issuer is able to raise capital at a moderate interest or preferred dividend cost, and if the expected prosperity materializes, the issuer will get rid of the senior obligation by having it exchanged into common stock. Thus, both sides to the bargain will fare unusually well. So this was this new development that Wall Street came out with back in the early 70s when Graham was writing, called convertible issues. Okay? Convertible preferred stock is what it's called today, and it's still in existence. And he was saying, here's how Wall Street is presenting it, like this great new structure that we came out with that turns out to be a win-win for the investor and the issuer. And here is Graham's comments on that. Obviously, the foregoing paragraph must overstate the case somewhere, for you cannot, by a mere ingenious device, make a bargain much better for both sides. In exchange for the conversion privilege, the investor usually gives up something important in quality or yield or both. Conversely, if the company gets its money at lower cost because of the conversion feature, it is surrendering in return part of the common shareholder's claim to further enhancement. On this subject, there are a number of tricky arguments to be advanced, both pro and con. The safest conclusion that can be reached is that convertible issues are like any other form of security in that their form itself guarantees neither attractiveness nor unattractiveness. The question will depend on all the facts surrounding the individual issue. Okay? And so what he's calling BS on this new form of investment called a convertible preferred stock. Okay, and he's saying just because you change the form, you can't make it a great investment. Okay, and here's the thing, that was in 1970s, and that was the form du jour, if you will. But in the last 50 years, Wall Street they do this all the time. From time to time, they come out with this new form of investing that is going to, somehow the form makes an investment magical, right? They had limited partnerships in the 80s. And because of these, you get this big upfront tax write-off. It made it a great investment. Well, if the underlying investment wasn't any good, your upfront write-off didn't magically turn it from a bad investment into a good investment. And a lot of people lost money in limited partnerships. Okay, you have deferred annuities, and what an annuity is, it's a promise to pay in the future. And it's a transfer of risk. of future payments from the purchaser to the issuer. So the issuer is usually an insurance company, and so like someone says, well, in 10 years I want to retire and get a check for the rest of my life, and the annuity company will say, okay, here's how much you got to put in, and I'll guarantee that you'll get that check. So that's an annuity, right? And that's the main benefit. One little side benefit was that it's tax deferred. And so Wall Street took that and ran with it. They said, we're going to tout this tax deferred nature of it, and we're going to put all kinds of stuff into an annuity. And when we sell it, we're going to talk about not the stuff that's in it, but we're going to talk about this tax deferred feature and all these little riders that you could put on it, right? And so it was the form of the investment that was the selling point, not the investment itself. And there have been all kinds of them. Delaware Corporation, 412I, 403B, 419, right? And it's often related to the IRS tax code, right? And they have seminars on them, and when you go to the seminar, they're talking about the form of the investment. And if you ever in a presentation, that's what they're talking about, the form of the investment, eat your lunch and leave, or just give them your free lunch and leave before even the free lunch comes, because it's just a sales pitch, and if they're not talking about the underlying investment, ask yourself, why are they not talking about the underlying investment? Do they have something to hide? Can it not sell itself on its own merits, that it needs this glossy wrapper around it? Not wrapper as in musician, wrapper as in the outside covering, right? Does it need this glossy wrapper to make it attractive to me, because it otherwise would not be, right? And that's what he's saying that Wall Street was doing at the time of his writing with these convertible preferred issues. They were touting the structure or the form and not the investment itself. And I'm reminded of what Sarah Palin said one time. She said, what's the difference between a hockey mom and a pit bull? Lipstick is what she said. And it was so true, in that just because you put lipstick on a pit bull, it's still a pit bull. You know what I mean? And that's what they try to do on Wall Street. They try to put lipstick on these pit bulls, so you think you're not getting a pit bull, but you're actually just getting a pit bull with lipstick, okay? And be careful. Be careful about presentations. And I get people calling me all the time, what do you think about this investment? This guy said it has all these kind of guarantees and bells and whistles. And the whole sizzle is the bells and whistles, and not one bit of the conversation about, well, what is the underlying investment that we're going to buy within this fancy structure that you have? Oh, don't worry about that. It's tax deferred, and you get all these guarantees and all these bells and whistles. Well, it doesn't work unless the underlying investment inside of it works. And I'll give you another example. There's a guy named Peter Thiel. He's a famous investor. He was part of the PayPal mafia, one of the guys that started PayPal along with Elon Musk and several others that went on to do a lot of interesting things. And he was an early investor in Facebook. And I mean, real early, one of the first, okay? And he did that inside of his Roth IRA. Not exclusively, but part of it was in his Roth IRA. And so today, he has a Roth IRA worth like $5 billion, because obviously Facebook has blown up since then, and that money has 1,000x'd or something, or more. Okay. So he has $5 billion in a Roth IRA. And guess what? He could pull that out whenever he wants and not pay a penny of tax on it. And the IRS is mad. And I think they tried to make a Peter Thiel rule about about Roth IRAs. And the story has been told and retold in a way to promote Roth IRAs. But let me tell you, Peter Thiel isn't a billionaire because he invested in a Roth IRA. He's a billionaire because he invested in Facebook early on. Okay? And people get caught up in the fact that, oh yeah, but it's in a Roth and he'll never have to pay taxes. True, that was a home run and it was a great move. And it probably say, if he were to pull that out and it wasn't in a Roth IRA, he'd pay north of $1 billion in taxes. And people say, yeah, it saved him $1 billion in taxes. But he'd still have $4 billion is the point. Okay, it's not because of the Roth IRA, it's because of the fact that he was an early investor in Facebook. And I know I'm gonna lose a lot of people on there because it's like, man, I would hate to have to pay $1 billion in taxes. Man, I would love to pay $1 billion in taxes. Because if I paid $1 billion in taxes, it means I probably have another $4 billion left somewhere. Right? The only people that get to pay $1 billion in taxes are people that have billions left somewhere else. And people get really confused about this. And I really want us to focus on the underlying investment. And that's what Graham is saying here. Don't get caught up in Wall Street's sales pitch to sell you something that's not any good and wrap it in something that makes something not good look good. Okay, I want to give you these are just hard numbers right here. And most of these are long-term investments that have this wrapper. And it only works with a long-term investment. And there's usually big commissions associated with them. But imagine you had $100,000, you invested it over a 20-year period of time. Here's what it would grow to at various rates of return, okay? At 4%, if you were earning 4% a year for 20 years on $100,000, in 20 years you'd have $219,000. It will have a little more than double. Now, if you had invested the same amount over the exact same time period, the only difference is your investment averaged 8%. Okay? You would end up with $466,000, more than double, having invested the same amount for the same period of time. If you would have invested at 12% over that same 20-year period, the same amount, that 100,000 would have grown to 900,000. Almost 4 times as much as if you had invested it at 4%. At 16%, over 20 years, that 100,000 would have grown to $1.9 million. For doing the exact same thing, putting away 100,000 and letting it grow for 20 years at 16%. At 20%, $100,000 over 20 years would have grown to $3.8 million. At 4%, it's 200,000. At 20%, it's $3.8 million. But what if you were getting 4% in some kind of cool wrapper, like a deferred annuity or something that you could pull out tax-free and borrow against it, and all these cool benefits to it? So what? It's only $200,000. You understand what I'm saying? I would much rather pay taxes on 1.9 million than have 200,000 tax-free. Wouldn't you? Yeah, but on 1.9 million, I'd have to maybe pay 500,000 in taxes. I would hate to pay 500,000 in taxes, someone would say. Really? But you're left with 1.5? That's still way better than 200 tax-free. That's a hard concept to grasp. I know. And it's enticing to be lured by the allure of a lipstick wearing pit bull. And unscrupulous people in my business make careers out of doing this. They make big commissions and they get sent on trips, and it in a way it breaks my heart, because those deals with the rappers are the ones that pay the big commissions, and they get a lot of people, and they convince themselves that they're not doing something that's wrong for their clients, and it's not in, or maybe if not wrong, but maybe not in the best interest of their clients. And I really just wanted to point out that this is nothing new. Those collateralized debt obligations that contributed to the global financial crisis in 2008 were another form of a terrible investment wrapped up in this wrapper that made it look AAA, and people bought them. People lined up to buy them without knowing what was the underlying investment. And it wasn't the first time Wall Street did that card trick, and it won't be the last. And it's gone by many names, and it'll happen again. And people will line up to buy it because they'll be focusing on the wrong thing. And I if you ever hear in that presentation, give me a call. I'll talk you down. And we'll look at what is the actual underlying investment, and is there quality and value in that underlying investment, with or without the wrapper around it. So that's chapter 16, by the way, first page of The Intelligent Investor, if you want to read it for yourself. But yeah, well, I just want to put out this warning that this happens all the time, and I hope to protect my clients from this trap. Okay, hope you have a great day.